US stocks dropped close to 6% in the month of April, its biggest drop in 2024. But in the last couple of days, it looks like bulls have started to take back control. So should we see higher stock prices in the months to come? Well, let's find out in this video. So US market started out the year for the first 3 months very strongly. The market was up over 10%, and then just like clockwork on the 1st of April, the market started selling off and it dropped all the way down to almost 6% in the month of April. So why did the market drop? Well, you always need something to blame. So the market was blaming the rising tensions in the Middle East, rising oil prices, and people started talking about stagflation, which means that the economy is slowing down, plus inflation is not dropping as fast, and the Fed suddenly came out and started to say, well, we may even raise interest rates again. So that spooked the market, and that's why the market sold off. But as I always say, the markets will always find a reason to wave up and always find a reason to wave down. And if the market didn't drop because of those reasons, it would have dropped for other reasons. Because remember that in a bull market, prices can't go up in a straight line. It can't go up every day, every week, every month. It has to drop once in a while to shake out the weak holders before the market goes higher. It just so happened this time the sell-off was in April, which was long overdue. Because remember that the market usually sells off usually in February. That's based on seasonality patterns. And that's why you can't always predict exactly, because the seasonality pattern doesn't always play out exactly. So usually in election years, you have got a bullish January, which we were bullish, we were up 2%, and a bearish February usually, but we were up 4.87% in February. So it's kind of like the sell-off was delayed. And then in March, the market was bullish by 3.05%, and April, which is usually a bullish month, was down 4%. So to me, that drop in April was supposed to be the drop in February that got delayed to April. Right? So where do we go from here? Do we expect the rest of the months to be bullish? Well, again, based on seasonality, on election years, May is actually bullish, but very slightly bullish. But June, July, August, the summer months are actually pretty bullish. And then you get the usual sell-off in September, October because of the uncertainty over the US election. And then once the US election gets going, the uncertainty is lifted, regardless of who wins, the market then rallies all the way to the end of the year, and usually the year will end up pretty positive on an election year, especially given this year where economic growth is strong, earnings are good, and as long as inflation doesn't spike up too much again and the Fed doesn't start raising interest rates again, we should see another double-digit year this year. This is the same thing except shown on a chart, and you can see again, we should end up the year positive with a pretty high probability. So is the pullback that started in April over, and are we headed higher from here? Now again, there's no way to predict with 100% certainty because there are too many moving parts, but I think that there is a pretty good likelihood that it is a bottom for this particular pullback and we should be heading higher for a few reasons. First, the technical reasons. And the first technical reason is that it's already down from peak to trough close to 6%. And remember that statistically, the market tends to drop at least 5% 3 times a year. So the fact that it's dropped more than 5% for this pullback, it has met that quota. Number two, if you actually zoom out to the weekly candles, you can see that it actually bounced off the 20 exponential moving average. The red dotted line, it bounced off. So that could mark a potential bottom for this particular pullback. Again, if you zoom back down to the daily candles, you can see a kind of like a slow uptrend pattern over here, right? Wave up, wave down, wave up, wave down, wave up. So it is starting to make higher highs and higher lows, although it is now facing a bit of resistance from this blue line, the 50 moving average. So if you can break above that 50 moving average, then it's going to be an even higher chance that the bullish momentum will continue in the next couple of months. Now, for the fundamental reasons, we can just look at charts, right? So remember, the reason that this pullback happened in the first place was, number one, the Middle East crisis was flaring up. And that now seems to be like not talked about in the media anymore. When Israel and Iran were attacking each other, that's kind of like out of the focus of the media. So that's kind of like resolved, right? The second thing was the oil prices were spiking higher. That has come back down. So that has been resolved as well. And the third thing was the fear that the Fed was going to increase interest rates. That freaked everyone out. That's off the table because Fed Chair Powell came out a couple of days ago during his news conference and he said, no, we are not going to raise rates. Don't worry. We are going to cut rates. It's just that I can't tell you when, but sometime later this year. So that actually caused the market to bounce back up again. And of course, the thing that has given the market a new lease of life in terms of the bullishness have been a strong earnings report. Amazon, Meta, Microsoft, Apple have all announced better than expected earnings. And overall, if you take a look at the S&P 500 companies, 77% so far have beaten their earnings per share estimates for quarter one earnings season. And this is equal to the 5-year average of a 77% beat and a 10-year average of 74% of companies beating earnings estimates. So this has been a pretty strong earnings season so far. And if you take a look at the current EPS season, from another angle, you can see that it's the strongest surprise beat over expectations over the last 9 earnings seasons. So very strong earnings, and that is what's propelling the market higher. Another interesting statistic to note is that historically, whenever the first quarter of the year is positive and April is negative, May tends to be pretty bullish as well. So for example, if you take a look at history since 1985, there have been 7 times when the market was positive in the first quarter and there was a negative April. So years would be 1985, 86, 87, 93, 2000, 2004, 2012, and of course now this time 2024 that has not yet played out. So for the first 7 occurrences, you can see, yep, quarter one was positive, April was negative. So what happened in May? And out of those 7 instances, you can see that 1, 2, 3, 4, 5 out of 7 of them, May was positive. So 5 out of 7 is a 71% probability of a higher May. Although yes, it is a pretty small sample size. And then from May to the end of the year, May to December, you can see that 1, 2, 3, 4, 5 out of 7 were also a positive gain, which again is a 71% probability. Now, if you take out the year 2000, which was a bear market, and you look at only the bull markets, which we're in this year, then the probability is a bit higher, right? Taking out the bear market, you can see that 1, 2, 3, 4, 5 out of 6 years was positive for May. So that's 83% win rate. And same thing, May to the end of the year, 83% chance that you'll be positive in a bull market year. The pullback in April was really great because it gave us investors a chance to add more shares to the high quality companies that went down temporarily and they were undervalued. But now that the market is bounced up, for investors who missed out on that nice drop, is it too late? Are there still some stocks that are still undervalued that are still worth picking up? Well, let's take a look at a few examples. First of all, Amazon that just announced blowout earnings, and of course the stock traded a lot higher and it popped up over here. But despite that, if you calculate the intrinsic value based on a discounted free cash flow valuation, you'll find that the intrinsic value is $233. So at a current price of $186, it is still undervalued. But having said that, one of the things I teach my students is that even if a stock is undervalued, I wouldn't add it until I see a wave down to a level of support. Remember, prices move in waves, right? You've got, wave up, wave down, wave up, wave down, wave up, wave down, wave up. So I always like to wait for a wave down to add near a level of support. So in the case of Amazon, yep, it is still undervalued fundamentally, but it is now beginning to wave up. Sure, if you want to buy it right here, there's nothing wrong because it is undervalued, but of course, it's always great to wait for a bit of a pullback before adding a bit more. And Amazon is a company which, if you recall, about a year and a half ago, I talked about how their evil plan was to take over the entire world. And that's why today Amazon is the biggest position in my portfolio. Because I think that it's still massively underestimated by the market. And once the market wakes up to the fact about how much free cash flow it can generate in the years to come, there's going to be a huge upside for Amazon. The next on the list will be, of course, Meta. Now, Meta is pretty interesting. So it announced great earnings, record earnings, and what happened? The stock price dropped because Mark Zuckerberg in the conference call mentioned that he would like to make more investments into AI and the metaverse, and that freaked people out, which was great because it caused the stock to gap down. And yep, I added more shares, so did many of my students, because to us it's a great opportunity because Meta is very undervalued. Now, for Meta, I did a revaluation, and even using the most conservative growth rates, I find Meta's intrinsic value at $545. And if you actually use the projected growth rate that most analysts use, you'll be shocked. Meta will be worth probably about $700 to $800. But even being very conservative, is still worth $500. So Meta, to me, is one of those stocks that is still very undervalued. And now that it has dropped, and is beginning to find its way back up, is still a great opportunity for longer term investors. Now, again, bear in mind that all these things that I'm talking about are not meant for short-term trades. When I say I love this company, it's undervalued, doesn't mean the price must go up today or next week or next month. It just means it's undervalued and there's tremendous upside for longer-term investors. But having said that, if you look at the price action, this looks like a pretty good swing trade opportunity as well. All right, so we've got Amazon, we've got Meta. How about Microsoft? Microsoft also announced great earnings, although it was not blowout, but it was still better than expected. Amazon is slightly overpriced. So my intrinsic value for Microsoft is $400. So it did drop after earnings. And it was slightly undervalued only for a short period of time, and now it's back above the valuation. So now it's slightly overvalued, but again, if it trades back down again, could be an opportunity to add more Microsoft, one of the leaders of this AI revolution. Not too long ago, people were saying that Google is losing market share to Microsoft's ChatGPT, that YouTube subscription was going down, that Google's gonna die, it's a terrible stock, and the stock was dropping, everyone was panicking. Well, what happened? Yeah, Google announced blowout earnings. Their YouTube revenue up 20%, revenue up 15%, and their earnings per share up 57%. And Google, gapped up as a result. Let's take a look at Google. Nice gap up. And of course, after strong gap up, you got a bit of a retracement. And even if that, is Google expensive? No. Once again, do a discounted free cash flow valuation. You can learn how to do intrinsic value calculations by taking my value momentum investing course at piranhaprofits.com. You get the intrinsic value calculator. Do your own calculations, see for yourself. And you'll find that Google's intrinsic value is about $191. So yes, it is still pretty undervalued at this level. But again, as always, even though it is fundamentally cheap, would I add Google right here? I will not, because I like to add it near support levels, near the moving averages, right? Because after wave up, wave down, wave up, wave down, always add on a wave down. So you can see that even though this bull market is in its second year and the markets have delivered great returns, and even with the market rebounding the last few days, you still have got very good companies that are still undervalued. So when people say that, oh, the market's in a bubble, there's nothing to buy, absolute rubbish. They don't understand how to value individual companies. And again, there are some other great companies that are still very, very undervalued. They just retrace and they drop because of short-term uncertainty. One more example would be Fortinet. Fortinet is one of the leaders in cybersecurity together with its main competitor Palo Alto. I own both companies. I own Palo Alto and I own Fortinet. And Fortinet, they just announced their earnings, which were not bad. They beat on revenue, they beat on profits, but their billings was a slight miss. And share price dropped 10% one day, right? And it's now kind of like right at this 150-day moving average on weekly candles. And it also happens to be a significant level of support. So I'll be watching this pretty carefully. And if the price can rebound back and close back above that support level, we may see a rebound back up. Or if it breaks down, it could see a bit more downside before it rebounds. But again, if you calculate the intrinsic value of this company, it's about $82, so it is still significantly undervalued. And a lot of the problems it's having in terms of the reduction in billings, to me, are short-term cyclical concerns, right? So their service revenue is very strong. It's up 20%. It's their product revenue from the firewall products that have been declining. And that is more of a cyclical thing, right? Historically, this company has gone through short-term cyclical drops in hardware product demand, but eventually it will begin to rebound. So again, if you're a long-term investor, great to look at cybersecurity companies that are trading at a discount right now. Because long-term, cybersecurity is definitely in a very strong long-term uptrend growth phase. Speaking of bull markets, guess which other market has just gone into a bull market again? That's right, China. So remember that the definition of a bull market is when prices rise and close 20% above the low. That defines a bull market. So when people argue with me like, Adam, are you sure it's a bull market? You know, it's not a question of opinion, it's a fact. That's the definition of a bull market, okay? So since last week, you can see the Hang Seng Index, that's the bear market low. It closed above 17,754. That is the 20% upside from the low, so that marks the start of the bull market. But again, for me personally, I also like to ensure that the 50 moving average, which is this blue line, crosses above the 150 moving average, with both moving averages flattening or sloping up to confirm the new uptrend. So that has not happened yet actually, right? It's on the verge of crossing, but not just yet. So for me, I'm not going to declare as a bull market in my own terms until I see that crossover, which I think is going to happen in the next couple of days. Or if the 200-day moving average starts to slope up, that is also the confirmation of a new strong uptrend. So we're pretty close, right? Now, having said that, you can see when a new bull market happens, when prices move up in a parabolic fashion like 90 degrees, I wouldn't chase it right here. I'll always wait for a bit of a retracement or pullback before getting into the market to ride the new bull market. But of course, having said that, you guys have heard me say before that I'm done with China, right? And right, I'm done with China, so I'm not adding any more shares. What I'm doing is I'm holding the shares I already own, and I'll be looking to exit my China shares once they go higher, nearer to the fair value, nearer to the intrinsic value, which could be double from current prices, because many China stocks are very undervalued. So I'm not adding more, I'm just holding and getting out, right? Once prices double or triple from current levels. And they will, it's only a question of time. Now that sentiment has begun to shift. So how cheap is the China market? Well, for the Hang Seng Index in particular, you can see that the long-term average PE ratio is about 11.64 times earnings. If you compare it to the US market, US is selling at 20 times earnings. But then again, the US market is more certain, has higher growth rate, so you can't really compare apples to oranges, right? So that's the average PE ratio. The low PE ratio is 7.49 times. So currently, the Hang Seng Index is trading at 10.14 times PE ratio. So we should, in a new bull market, at least get back to the average PE of 11.64 times. Okay, but will it get back to the high of 19 times? Yes, I think it will. It's only a question of time. May take a year or two to get back to that high level. Now, am I going to wait for it to go back to the high to sell all my China stock? No, I'll probably start selling once I get maybe somewhere around here. Once I get above the average and maybe about halfway to the top, I will start to slowly scale out my positions until I fully exit the positions. And for that, I'll look at the individual companies' intrinsic value to make my decisions as well. So how much upside is there if this bull market continues going up? So right now, as you can see, the Hang Seng is right here. So in order to get to the 11.64 times earnings, which is the historical average, it's about 9.8% upside from current levels. And I think that it can easily reach there this year. all right? And I also see a next major level of resistance at 22,654, which happens to be the 13 times PE level. And that would represent a 22% upside from current level. So if you ask me to make a guess, I would guess that from now to the end of the year, the China stocks, the Hang Seng market, would probably gain between 9.8% to 22%, right? Anywhere between these two levels. So there is a pretty good chance that this will be one of those years where both the US market and the China market will be in a very strong bull market. Hope you enjoyed this video, and remember, please subscribe. And legend has it that the next 500 subscribers to help this channel get above 1 million subscribers will generate over $1 million in profit in the stock market very, very soon, and also enjoy 50 years of great sex. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.